Hi, thanks for watching this Finance with Excel video. And the second part of the two-part series where we analyze and understand all that goes into a housing payment. We're going to add the remaining portions of a housing payment, which include private mortgage insurance if you need it, taxes, homeowners insurance, and potential HOA fees. And so we're gonna build all of these into our workbook so that we can get a more comprehensive view of what our housing expenses are going to look like. First, we're going to do is we're going to look at private mortgage insurance. Private mortgage insurance is required by your lender when you do not have sufficient equity in your home. The reason why they require it is because if you don't have much equity in your home, the cost to walking away from your home is much less, and therefore the probability of default tends to be higher when people don't have much equity in their home. And so what mortgage companies will often do, or what they will almost always do if you don't have at least 20% equity in your home, is they will require you to go buy private mortgage insurance. And what private mortgage insurance does is it guarantees that your lender, your bank, will get paid if you walk away from your mortgage. So you are paying another company to write insurance on your mortgage. That way, if you default, your lender gets paid. It doesn't pay you, it pays your lender. The threshold for private mortgage insurance is almost always 20%. If you put 20% down, then you don't need private mortgage insurance. If you put less than 20% down, you'll almost always have to buy private mortgage insurance. So to analyze this, I'm first going to create a field called PMI required. And what this is simply going to do is it's going to ask the question, if your down payment is less than 20%, then give me a yes. If not, then give me a no. Alright, so in this case, we had less, but suppose I only put 5% down. Like a lot of first-time home buyers, they don't have, to buy a $200,000 home, you'd have to have $40,000 plus closing costs, so probably around 45 grand, to get this home on a traditional mortgage. Let's say you only have 5% down, and you can do that. So, next thing we need to know is what is the PMI rate. Now, the PMI rate is what the insurance company will do is they will charge you on an annual basis some percent of the value of your mortgage. So if this is the case, if I put 5% down, the value of my mortgage would be $190,000. So in the first year, to cover this mortgage, they would charge me some percent of $190,000 spread out over the 12 years. Typically, they run about 1%. Is what a private mortgage insurance rate will typically go at. They can be as low as 0.5% or as high as 2%, but typically they'll be about 1%. If you're getting PMI insurance, then you can put your given rate in there. And the next thing we need to know is our house appreciation. And because there are two ways that we can drop our PMI insurance when we have a sufficient amount of equity in the home, meaning that our home is worth more than our mortgage by a sufficient amount, by at least 20%. And that will be the case. One, if we put 20% down, then our home is worth 20% more than our mortgage. Another way would be is if our home appreciates over time and gets more valuable, whereas our mortgage, should be going down in value. Then our home's appreciation over time will eventually allow us to get rid of the PMI. Also, paying down our mortgage helps us to get rid of our PMI. So I'm going to put a 2% appreciation rate into our home mortgage or our house appreciation. Now, depending on where you live, this could be higher or this could be lower. If you're living in a high demand area, then it will likely be higher. If you're living in a low demand area, it could be lower, or it could even potentially be negative. So then the next thing that we need to do is we need to calculate what is my home value based on this appreciation rate. So right now my home value in period 1 is simply going to be the value that it is in when we bought the home. Now, and then that's going to be, so at the end of our first month, it's going to be the value that we paid for our home, and we want to make sure that you anchor on that, and then it's going to be there's whatever appreciation we're going to get after that. So to calculate the appreciation, it's going to be 1 plus whatever our appreciation rate is, make sure you anchor on that, divided by 12. And then we're just going to raise that to the number of periods. And then that will calculate, that will compound our appreciation for as many periods as we're doing it. So our home value at the end of our first month is likely $300 more than what we paid for it. So then we need to calculate our equity ratio. Now our equity ratio is simply going to equal 1 minus the mortgage amount divided by our home value. So, like you said, when you initially buy your home, if you put 5% down, your initial equity is going to be about 5%. It's going to be 5%. So then we need to calculate what our PMI is going to be. So actually the way PMI works is at the beginning of each year, they will calculate your mortgage amount, take 1% of that, and then divide that over the year. That would require a lot more steps to incorporate that into Excel. So we can get a really good approximation by just taking our mortgage amount multiplied by our PMI rate, make sure you anchor on that, divided by 12, because you're going to end up paying, and this will give you your PMI within just a couple of dollars, what your total PMI is going to be. So this is going to give you your PMI. Now remember remember what we want to do here is we want this to stop giving us numbers after we've paid off our mortgage. So we're going to say if our period equals blank, then give me a blank. If not, then give me what we just asked it to give us. And we're going to do the same thing to this equity ratio. We're going to say if our period equals blank, then give me a blank. If not, then give me our period. And same thing with our PMI. Oh, but our PMI is actually a little bit different. So what we're going to say is if our equity ratio, actually we're using or statement, we're going to say or if this equals no, or our equity ratio is less than 0.22. Now, why is it 2.2? So typically, to get rid of your PMI, you need to have, what I've read at a bunch of places, you'll need to have 22% equity in your home. To not get it, you need 20%. To get rid of it, you need 22%. So what this is saying was we're just saying an or statement. So if our PMI required is equal to no, or if we have sufficient equity in our home, then we don't have a PMI payment, so just give me a blank. If not, then give me our estimated PMI payment. Now the other thing, so we've got this. Now the other thing we need to do is then say if period 1 is equal to a blank, then give me a blank. If not, then give me whatever's in this if statement. So this should be if it's greater than. I messed up there. I apologize. So if your equity is more than 22%, then you can typically drop your PMI. So now we can drag these down, and it will tell us over time what our equity ratio is going to be. And so we can come down, once our equity gets to 22%, we can see that PMI drops. And then once we pay off our home, then see our equity ratio is 100% once we've paid off our home. So this takes care of that. So now what we want to know is the total PMI payments. And that is equal to simply the sum of this PMI column. Oops. It's giving me So you'll notice actually when I did that, I ended up getting a circular reference. This is actually, so the reason why, and most of these problems come because of problems with anchoring. Now we'll see, what we can see here is that right here, when we're saying is E1 equal to no, I forgot to anchor right there. And so the problem was when I was dragging it down, this cell reference was dragging down to here, so it was saying you can't reference two cells to each other, so I got a circular reference. But that should fix that. and then there we go. So if this were the case, I would have paid, in this situation, I would have paid $8,000 or $9,000 in total PMI payments. So the next kind of major section or thing that goes into our payments is is taxes. And for taxes, lots of different localities do taxes in a lot of different ways. The way we're going to do it is this is one common way that companies will do taxes, or that municipalities will do taxes. They'll have a tax rate of maybe like 4%, and then they'll have an assessment rate of maybe like 25%. So what this means is that they will take the value of your home and they will multiply it by 25%. So instead of paying taxes on all 100% of your home, they say you're only paying taxes on 25% of your home, and then the tax rate that they apply to that 25% is 4%. So we can calculate our taxes, and that's going to be your annual annual tax rate. So our taxes are going to equal the home value multiplied by the assessment rate, make sure you anchor on that, multiplied by the tax rate. Make sure you anchor on that, divided by 12, because you don't pay this every single month, you pay it annually. So your taxes are going to be about $166 per month to pay for this $200,000 home. If these were your tax rates, for whatever your municipality is, you can put that in there. Lastly, we need to put in there, we need to say if the period is equal to a blank, then give me a blank. If not, give me what I have right there. So we now can calculate, and we can see that over time our taxes are going to gradually increase as the value of our home increases as well. So the two last kind of key components to your housing payment is homeowners insurance and HOA fees, if you have any. So homeowners insurance, your bank will require you to have homeowners insurance because if a tornado comes and destroys your home, they want to make sure that they can get paid back for the loan. Just a quick Google search of homeowners insurance shows that homeowners insurance in the United States averages about $80 a month in the United States. You can change this for whatever your particular home is. Now HOA fees can vary dramatically. If you live in an expensive condo in New York City, they're going to be there could be thousands a month. But typically your HOA fees are going to run maybe $100-$200 a month, depending on where you live. HOA fees, if you live in a condo, they help pay for like maintaining the elevators and the grass and the whatever. If you live in a nice neighborhood, they might help pay for a community pool and things like that. So those are your HOA fees. So now we can come over here and we can calculate our payment. So our initial payment is principal and interest. So I just call it P&I. So principal and interest, our principal and interest payments are going to end up being our minimum required payment plus any extra payment that we choose to give. Then we're going to need to have our PMI. Now your PMI is going to change over time, but to get into this home, if this is what you're doing, your PMI is going to be about $158 a month. Your taxes are going to change over time, but initially when you buy this home, it's going to be about $167 a month. And then your insurance is going to equal about $80 a month, and your HOA is going to equal about $100 a month in this case. So now we have a good overview of exactly what it's going to cost you to actually buy this home. And it's just going to be the sum of all of these things. So what we can see here is that this $1,400 a month is going to be your total monthly total payment. And so now we can see, now we can change this, and we can say, now suppose, you know, we all of a sudden get a whole bunch of money, and we put 500,000, we get a $500,000 home. We can see that and this is the same thing changes. Then we can see this is what our payment structure is going to look like. So now we can see that you know, even though, you know, we're only paying $2,200 a month for this $500,000 home, in order to actually live in this home, we're going to end up paying about $1,000 extra in all these other things. Now, if we could put 20% down, then all of a sudden it would drop to $2,500 because PMI drops out. Hope this is useful. Thanks for watching.